Retail traders are actively bleeding capital. Right now, thousands of Bitcoin short positions are getting wiped out as the price breaks above $72,000. These liquidations occur because many traders are misinterpreting the immediate short-term trend. They are placing high-leverage bets against specific liquidity pools that market maker algorithms are actively targeting. This psychological error is the Timeframe Trap, and it is the primary reason for the recent destruction of retail deposits. Bitcoin is currently confirming a technical breakout above resistance, but a hidden trapdoor is beginning to form on the 4-hour chart. We will isolate the specific RSI invalidation signal that identifies when a healthy market pullback transitions into a deep trend reversal. Mastering this specific timeframe divergence is the only way to protect your capital and trade alongside institutional money during this period of high volatility. This chart shows the S&P 500 on a 4-hour timeframe. This index serves as the macro engine currently pulling the entire crypto market upward. Over the last several days, the market converted a multi-month resistance block into a confirmed area of support. A verified bounce in traditional equity markets creates a bullish relief environment for risk-on assets like Bitcoin and Ethereum. This structural macro strength invalidates the bearish bias many retail traders are using to justify their short positions. When traditional finance maintains this level of momentum, the mathematical probability of a successful crypto short trade drops significantly. As Bitcoin pushes past $72,000, the resulting price action has left many retail bears confused by the lack of a reversal. This is a liquidation heat map, which visualizes where short seller stop losses and liquidation levels are concentrated. Notice the glowing red clusters of liquidity stacked directly above the current price. Retail traders continue opening new short positions, building a massive liquidity wall that acts as a magnet. Market algorithms seek out these clusters. The price spikes upward to trigger liquidations, providing necessary buy-side liquidity to move the market higher. This creates a feedback loop. Triggered liquidations result in mandatory buybacks, which instantly push the price into the next cluster of short positions. This is a cold, mechanical, algorithmic short squeeze designed to leverage the bearish bias of the retail majority. While the short squeeze provides upward momentum, a critical warning signal is now appearing on the 4-hour Bitcoin chart. This chart displays the 4-hour Relative Strength Index, or RSI, which is currently crossing above the overbought threshold. While Bitcoin's price is making higher highs, the RSI is making lower highs. This indicates a bearish divergence, meaning the underlying momentum of the move is decaying. This divergence suggests that over the weekend, we are likely to see sideways consolidation or a downward drift rather than a continuation of the squeeze. Technical analysts identify the $71,000 to $72,000 zone as a retest of previous resistance, which now serves as a logical reload area for support. Identifying this RSI trapdoor allows a trader to distinguish between a standard pullback and a loss of the short-term trend. When Bitcoin pauses at its range highs, capital rotation drives liquidity into major altcoins as traders seek volatility. This transition is creating an Ethereum setup. Ethereum has successfully executed a retest of the $2,200 support level, confirming the structural integrity of its current move. This chart shows Ethereum's price forming an inverse head and shoulders pattern, defined by 3 troughs and a horizontal neckline. The price target is calculated by measuring from the head to the neckline and projecting upward, pointing to $2,430. This move represents an 8% increase from the breakout point for traders holding the spot asset. Because Ethereum often acts as a high beta multiplier to Bitcoin's momentum, it offers a distinct risk-to-reward ratio for those who understand pattern mechanics. Solana is following a similar structural timeline to Ethereum, though its breakout has not yet occurred, providing a lead time for traders to prepare. The mandatory confirmation threshold for this trade is a 4-hour candle close above the $85.60 resistance line. Opening a position before the technical confirmation is locked in is a frequent error that leads to unnecessary losses on failed breakouts. Upon confirmation, the technical target sits at $93.30, which would complete a 9% move to the upside. For those using leverage, a 10x position would convert that 9% price move into a 90% gain on the trade. Executing these moves requires an exchange with deep order books. High liquidity is necessary to prevent slippage from eroding the profit margin of the 9% move. The trade is invalidated if Solana breaks back below the neckline. At that point, the hypothesis is no longer supported by the data, and the risk must be closed. Successful trading relies on the discipline to wait for technical confirmation and the use of a reliable execution platform. To navigate the current market, you must remain disciplined regarding timeframe divergence. We are currently seeing an aggressive bullish trend on the 4-hour chart that exists within a more neutral to bearish context on the macro weekly chart. You must trade the trend that is active in your specific timeframe while remaining aware of the support retest at $71,000. Managing the short-term upside is only one part of the strategy. Surviving a larger macroeconomic reversal requires a different dataset entirely. Click the video on your screen to learn about the hidden on-chain metric whales are currently using to identify the true macro market bottom.